Akash Prakash, Chief Executive Officer and Managing Director of Amansa Capital, joins us from Singapore. Akash, fantastic to have you back on ET Now. Thank you for joining us. Akash, the market environment is unfortunately looking quite ugly. Everything has fallen very hard. Stocks are on a butcher block. Are you getting a sense that the pain is here to stay?
Here to stay? No, in the sense that I think we're getting near some type of capitulation level, in the sense that the type of price action we've seen in the non-defensive sectors in the last couple of weeks has been quite brutal, as you know. I think you alluded to yourself. You look at what's happened to the banks. You look at what's happened to the industrials and stuff like that. So I think those sectors and stocks are coming, in my view, very near capitulation type of levels. So, I think the problem is that I don't see dramatic downside from here unless something goes really wrong on the rupee. But I don't see any significant upside either. So I think you're capped. That's the problem. I mean, someone would argue that, I'll invest in India when I see the upside. But right now there isn't much short term you can argue for a significant bounce up in the markets. I don't think it goes down dramatically, but I don't see any massive upside either.
Do you think then that the markets are pricing in an economic slowdown and no earnings recovery in FY14, or do you think there is still some fault in the system?
No, I think markets are now coming round to the view that there's not going to be much of a second half of the year recovery. I think the leg down you've seen in banks, the leg down you've seen in industrials in the last couple of weeks, the way the mid-cap stocks have got slaughtered in the last couple of weeks, I think to me indicates that the market is now coming around to the view that there is no second half recovery, that we will bounce around at this 5% type of GDP growth rate for some more time. So I think the market is now moving, which is why I think the capitulation phase is now coming here, where people are just giving up and saying there's no economic recovery anywhere in the horizon. So I think that the market is probably 70-80% of the way there in terms of pricing in no recovery for the second half of this year.
Akash, you're right that at the current juncture it's very easy to make a bearish argument. But in times of adversity, where is the opportunity?
Well, I think the opportunity is in those sectors which are getting slaughtered. I mean, and I've been saying this for some time, I don't see any opportunity in the consumer-facing sectors because they're just too expensive. Those stocks are, trading at very high valuation multiples, priced for perfection, and their economic fundamentals for those stocks are actually deteriorating. You look at Lever's volume growth down to 4%, Nestle volume growth down to 3%. So, those stocks are priced for perfection when their actual fundamentals for those companies are actually on the margin getting worse in their last results which they've shown. I think the opportunity is in the sector we're getting slaughtered. So if you look at mid caps, interesting stuff there. You look at the banks. I mean, a large swath of your banking system is now trading below book. You may question how valid the book is, but those stocks, some of them are clearly trading below book even on a if you haircut the book significantly. And so I'm not saying you buy public sector banks. I'm not a fan of public sector banks, but there are other banks there, which are also trading below book. There's some, consumer cyclical type of stocks, media or other things where, again, the stocks have got hammered. And if you take any expectation of normalized earnings power, these stocks are actually not very expensive at all. So my view is the opportunity is in the stuff which has got slaughtered. Obviously, a lot of it doesn't deserve to be invested in because they have issues on balance sheet or promoters or governance or whatever. But in those sectors, there are stuff you can find, which I think on a 2 to 3 year basis under any scenario in which the economy stabilizes and gets back to even 6.5% type of economic growth, I think those stocks will do very well.
Akash, you've liked private banks in the past. Do you think private banks have lost their status now of being safe havens?
No, I don't think they've lost this in the sense that, I think the stocks will still do well because, you may argue that they had gone up too much in terms of valuation and therefore, the valuation excess to a certain extent is getting corrected. But if you take a 3 to 5 year view, I still think the outlook for private sector banks is extraordinarily favorable. They're an environment where, any type of economic stability, they will do well. They're you would argue, though they're not showing it yet, but asset quality pressures are rampant in the banking system currently. NIM pressure is there right now. But they have a huge growth opportunity because the public sector banks are very undercapitalized. The public sector banks will have genuine growth challenges over the next 3 to 5 years because they don't have capital. They were very, they don't have a very young workforce. So there is a huge opportunity for the private sector banks to keep gaining market share from the public sector banks. And even if you assume, 5, 7 new licenses are given, by the time those people actually set up banks, by the time they gain any traction at all, that's 3 to 5 years away. So I think for the next 3 to 5 years, you have a real sweet spot for the existing private sector banks, where they can gain huge chunks of market share and do really well. And I think the valuations now for a lot of them have come down by 15-20%. So we still like private sector banks. We think that's a good space to be in.
Akash, you have a large exposure to Indocin Bank. Now, why has Indocin Bank as a stock corrected so much? And do you think somewhere markets are unduly worried about what will happen to the wholesale borrowing of some of these private banks?
No, I think markets are worried, rightly so, on the short term. I think the short-term wholesale rates have gone up significantly, 200-300 basis points at least. And there is some, access to wholesale borrowing is still not a problem, but cost has gone up significantly. So for anyone which has significant wholesale borrowings, and Indocin has some, it's not dramatic exposure to wholesale, but it does have wholesale exposure as well. There will be a cost of funding issue, which I think is a 2-3 month problem. So I can see from a short-term perspective that will impact NIMs and profitability. So that's one thing why Indocin Bank is getting impacted. Second, I think it's people still don't believe their asset quality on the CV, on the LCV and CV side. I think, though even another company we look at, Chola, is showing equally good credit asset quality. Some other players in the space also still show reasonably good asset quality on this whole commercial vehicles cycle. I think people still have their concerns around Indocin, saying that maybe, there will be some credit blow up down the road. I don't think there's any credit problem in Indocin's books. I think they're a very high quality management team. They've been very credible. They've done whatever they said they would do. So I still believe that, that they will do fine. But obviously the market seems to have a concern that there is a potential credit issue coming down the road for Indocin because of their exposure to the CV cycle.
Akash, what's the best way then to really bet on the Indian consumer space? If staples are expensive, opinion is divided in auto and more pain for private banks in the short term.
Yeah, no, it's a tough call. You can. The problem is those sectors are very expensive. So, my view would be that there's no point buying FMCG. So you could buy maybe media as a disguised play on consumption because, if FMCG growth slows down, like I think it will, they will have to pump more money into advertising to maintain volume growth. So media could be one way to play it. Second is, you could play some of the agri input stocks, which are play into not rural consumption in the sense of FMCG consumption, but they're a clear play into a good monsoon. So, if you look at things like, Coromandel or Rally or stuff like that, they don't have any economic sensitivity. They're not linked to the investment cycle. They're a clear play on a strong monsoon and increased purchasing power with farmers. So if farmers have more income and feel confident about their outlook for crops, they will spend more money on agri inputs. So that could be another way of playing it. But the simple classic way of playing it, I think is consumer staples is a tough way to do it right now because of the valuation.
Akash, whereas it's easy to buy into IT, do you think it's getting increasingly difficult to enter into pharma stocks given the divergent trends? One side of the spectrum you've got Ranbaxy and Wockhardt, other end of the spectrum you've got Lupin and then Sun Pharma.
Yeah, but pharma always has been, Nikunj, always been a little bit dicey in the sense that, it requires a bit of technical and specialist knowledge to understand the molecules and, the real profitability of a molecule, because every molecule, frankly, is different in terms of, is it a para 4, is it a first to file, is it a whole bunch of, how complex is the filing, how many competitors are there, etc. So one is that you need to understand the pipeline for the pharma company that you're investing in. What is the quality of the pipeline? What's the potential profitability? And what's the risk to that pipeline in terms of launch dates and potential, will it be launched, not launched, litigation, etc. And on the manufacturing side, which I think what you're alluding to, like what seems to have happened with Wockhardt and what has clearly happened with Ranbaxy, I think that is a bet on the entrepreneur, the promoter, or the person who runs the company. That do you think, can you trust them to run a legitimate operation which maintains high levels of quality and high manufacturing compliance? I think it's unfortunate what's happened with Ranbaxy and Wockhardt, but at least in Wockhardt, I don't know the details, and we'll still see. It's a warning letter. It may get converted. It may become worse. They may be able to rectify it. It's too early to say on Wockhardt as to how serious that is, and is it a permanent problem. But Ranbaxy clearly, has been shown to be a case of clear, malintent. It looks like, where they falsified data and the manufacturing facilities were clearly, not up to par. So that's a bet on the entrepreneur. I mean, you've got to make sure that you bet on entrepreneurs who are in it for the long haul and who understand, the need to maintain compliance at all levels. I think the good Indian pharma companies, the ones you talked about, Lupin, Sun, and many more, I think do fully understand the need to maintain compliance, and I think they will.